afternoon, and thank you for joining today's webinar, the SA Standard Chart of Accounts for Not-for-Profit Organisations. My name is Sarah Gonzalez. I am an employee of Redback Conferencing and will be facilitating today's session. My role involves instructing participants, posing questions to the presenter, and bringing the complete webinar to a close. If you experience any issues in hearing the webinar from your computer, please feel free to listen via your telephone. You can do this by following the instructions which are located in the messages box in the bottom right-hand corner of your screen. You will need to dial the 1-800 number and when prompted, enter the passcode provided. This messages box can also be used if you wish to ask the presenter a question. Simply type it in this box and then press enter. The webinar will involve a PowerPoint presentation and question and answer sessions throughout. After the session, you will be directed to an online survey. Please take a moment to complete this survey as your feedback does help us improve in the future. Today's webinar will be hosted by Sue Raw. I will now pass the microphone on to Sue.
Well, good afternoon, everybody, and thanks for joining us this afternoon for this session as we look at the South Australian Standard Chart of Accounts for Not-for-Profit Organisations. This series of sessions that we at Not-for-Profit Accounting Specialists have been running on behalf of the Office of the Economic Development Board within the Department of Premier and Cabinet. So firstly, I'd like to start by introducing myself. As I said, my name is Sue Raw and I work for Not-for-Profit Accounting Specialists. I'm a chartered accountant and have been for the last 18 years. I have worked in large accounting firms, predominantly with an audit focus. I've also worked as finance manager in commerce, and this current role at Not-for-Profit Accounting Specialists I have been for about the last 6 years, working extensively throughout the not-for-profit sector in both accounting and consulting roles, and doing auditing work still as well, and presentations such as these. I do other presentations to boards on looking at the financial aspects of their roles as board members and other such things. Okay. What I expect, and I hope that you leave here this afternoon with an understanding of, is a basic understanding of the Standard Chart of Accounts, how to use it, what's the background behind it, and how to actually manage a conversion process from what you currently have in your chart of accounts to something that is compatible with the Standard Chart of Accounts. Up front, I would like to say that I recognise the timing of these sessions probably isn't ideal, being the 7th of June today, and we're very close to the end of the financial year if you are a 30 June year-end organisation. Unfortunately, we had to wait until the South Australian version of the Standard Chart of Accounts was passed by Cabinet in order to be able to advertise and run these sessions. And this passing of the document by Cabinet only happened in about 2 to 3 weeks ago, and so our hands were a little bit tied as to being able to do anything before then. Even though I can't see you face to face and you obviously can't see me, I would like the session to be interactive if possible. I'm quite happy if at any stage during the session you have questions. As Sarah said in the introduction, if you type them into the message box on the bottom right-hand side of your screen and then press enter, then I can address those questions as they relate to the presentation as we go. We will have some time at the end also if you have some questions at the end that have come out of the information that you've been given and you'd like to have those addressed. There'll be some time for that also. The outline of what I want to talk through this afternoon is why implement a Standard Chart of Accounts. I will talk you through understanding the Standard Chart of Accounts. And then I will move on to actually talking about the conversion process of converting your current chart of accounts to the standard chart of accounts, should that be a choice that you make for your organisation. This involves a few steps, the first step being a mapping process, the second step being actual physically updating your accounting software, and finally verifying that the conversion process has been effective and accurate. You've heard a little bit about me. It might help me and perhaps even some of the other participants this afternoon if you could just introduce yourselves. Obviously, if you just give me a brief introduction of who you work for, and what I wouldn't mind knowing is what sort of government funding you get, whether it's local, state or federal. So if you could just briefly type that in the message box and post that up, then that would be helpful. Thank you. Just waiting for those responses. I've got some, thank you. This form of session may be new to some of you, but don't be afraid to be a bit interactive. It does make it a little bit more interesting than just listening to the sound of my voice the entire time. Okay, thanks, Julie. Okay, so we've got a variety of people with some funding from a variety of different sources. Okay, thanks for that, everybody. All right, we've got all sorts of state and federal funding, people who are running their own practices, working for not-for-profit organisations, got some country people. Okay, that's great. Thank you, everybody, for that. I'm going to start at the beginning. For many of you, if you work in a finance role, this is obviously very basic, but I want to quickly run over the basic level of what is a chart of accounts, just to make sure that we're all on the same page, but we'll move on quite quickly from this point. So what is a chart of accounts? A chart of accounts is a means of collecting financial information in a way that's clear and logical, and it groups the information into basic categories, as you can see there on screen. Those being assets, liabilities, income, expenses, equity and cost of sales. And often you'll see sub-categorisations within each of those categories. Now, all entities, whether you're looking at a large corporate organisation, a very small not-for-profit, or a large not-for-profit, a government department, all organisations use a chart of accounts. However, they're all unique, and this then leads to much time and effort spent preparing or translating information, particularly when you're being asked to acquit information such for government funders. And often, because these chart of accounts can vary so significantly, it makes comparability of information quite difficult. So what we find is that a chart of accounts, which may start off as something fairly standard, often it's whatever the particular accounting package you may start with uses, but it is developed over time, and that is usually based on the decision-making needs of the users, whether they be internal users, such as management and the board, or external users, such as government funders, or their requirements based on legislative requirements or end-of-financial year reporting requirements. So what we see happen then is that the chart of accounts evolves over time, and from something that sometimes can start off quite simply, often develops into something that, if not maintained well, can become quite large and unwieldy and difficult to manage. And I'm sure there's probably a lot of you now listening to this who can identify with that, with a chart of accounts. Usually it's one that you inherit when you come into a particular role, and often it can be a bit all over the place. What then happens if you do have a chart of accounts that has become quite large and unwieldy, unless you have very strict policies over the coding of information and where it is to be captured in the first instance, it can become very difficult even within an organisation to understand that financial information and to have consistency. The use of cost centres can be an effective way of decluttering the chart of accounts, and we will talk about use of cost centres a little later in the session. I've seen the use of cost centres used very well, and I've seen some examples where they've been used poorly, and also examples where they're not used at all, which has led to some very large general ledgers or chart of accounts with lots and lots of accounts, many of them particularly outdated and haven't been used for a long time. A little bit like this picture, really. If you can identify perhaps with that, I'm hoping that for many of you, your chart of accounts isn't quite that built on and that out of control, but often that seems to be what happens. So having talked about what is a chart of accounts at that level, we'll move on to talk about what is a standard chart of accounts. The standard chart of accounts is a convention of agreed terms to classify financial information. It groups like information with other like information, and it's descriptive enough to give appropriate guidance of what type of information should be posted to what type of account. It provides us with a common approach to capturing financial information, and it also gives us a common financial language with which government departments, funders and not-for-profit organisations can communicate. And I'm sure many of you have examples of instances where at times you feel you are talking at cross purposes with your funders when trying to communicate about financial information or to explain acquittals that you've submitted. A key concept to do with the standard chart of accounts is that it is not a reporting tool, but it is a data dictionary. It's not simply going to be a matter of printing out the entire chart of accounts and submitting that to your government funders and saying, here's my acquittal. What the standard chart of accounts gives us, as I've mentioned before, is that common agreed terms and the way of classifying financial information in a consistent manner because of the detailed descriptions that will enable parties on both sides, whether not-for-profit organisations or government funders, to be talking the same language. So why are we looking at implementing a standard chart of accounts? I'm sure that you're all aware that there is a lack of consistency in accounting categories and terms used between government departments and not-for-profit organisations. I don't think this would be a surprise to any of you. This particular project in developing the standard chart of accounts that we currently have dates back to 2002, when researchers in the Queensland University of Technology School of Accountancy, through their arm being the Australian Centre for Philanthropy and Non-Profit Studies, did some research and came up with this very conclusion, that there isn't a great deal of consistency throughout the sector about the means of either capturing information, financial information in the first instance, or in reporting it. So a research team was then put together, which developed into a reference group to develop a standard chart of accounts to enable some consistency with the capture of financial information. This body has had wide reference throughout the sector, with people from very small not-for-profits who perhaps are in voluntary treasurer positions, through to finance staff in some of the very large not-for-profits who are very experienced in working with finances. There was also representation from all levels of government, from people from small and large not-for-profits, from auditors, from representatives from the 3 large accounting bodies throughout Australia, peak body representatives, and then there were members of the research project team. The Standard Chart of Accounts that has come out of that process is specifically for the not-for-profit sector. The initial process, as I said, was to utilise a wide reference group. This was done firstly at a national level to come up with a national Standard Chart of Accounts, which has then been altered for the unique requirements of each state. When the state-based Standard Chart of Accounts were developed, there was representation from all those levels that I previously mentioned within each state to ensure that the Standard Chart of Accounts for each state captured all the necessary information. The Standard Chart of Accounts in South Australia will become effective from the 1st of July 2011. What this means is that for all new funding agreements that are entered into on or after that date, the acquittal reporting requirements to government need to be in a form that is compatible with the Standard Chart of Accounts. If you have funding agreements that are currently operating that may be for, say, a 2 or 3 year period that were signed prior to that date, then whatever the old reporting requirements were would still apply. So this would be for recurrent funding that is re-signed and re-entered into on or after the 1st of July, or any one-off grants that were entered after that date. The use of the terminology within the Standard Chart of Accounts is mandatory for government departments. This comes about because of a decision back in April 2010 by the Commonwealth of Australian Governments, that is COAG, where they agreed that the adoption of the Standard Chart of Accounts will be used by all government departments. And this is at all levels of government. So that's federal, state and local government departments. Actual adoption of the Standard Chart of Accounts is voluntary for the not-for-profit sector. There won't be anyone at this stage coming into your organisation asking to have a look at your accounting package and to check out the Chart of Accounts to see whether what you're using mirrors the Standard Chart of Accounts. That is not the case. However, as I mentioned before, when you are asked to acquit financial information, it will need to be in a form as requested by government departments that is consistent with the information in the Standard Chart of Accounts. So we'll go through a little bit later in the session some of those decisions that would lead you to the point in deciding whether you will actually convert your Chart of Accounts or whether you will, in the interim at least, work with a transition program to translate what you've currently got in your Chart of Accounts to something that is compatible with the Standard Chart of Accounts. As I said before, the Standard Chart of Accounts has been developed on a state-by-state basis to capture some of the unique requirements in state-based legislation. The Standard Chart of Accounts itself refers to documents such as the Income Tax Assessment Act, which is a federal act and therefore is consistent on a state-by-state basis, but you will find reference within the Standard Chart of Accounts to that act where certain pieces of information need to be collected and reported on in order to comply with that act. Similarly, the Associations and Corporations Act, here this is reference to the South Australian version. Other states have their own versions of Associations and Corporations Act, each with slightly differing requirements, and where there are differences that impact on the capture of financial information, those have been incorporated into this document. The Collections for Charitable Purposes Act. This reference here is the South Australian Act, and you will find reference to that within the Standard Chart of Accounts as well. This is the area under which the state-based Standard Chart of Accounts do differ in the main area under charitable collections, because the various acts around the country do have quite different reporting requirements. And so those have been incorporated within the Standard Chart of Accounts. When you come to look at the version of the Standard Chart of Accounts a little later, you will find reference some places where it will say SA only, Vic only, Queensland only, and generally they are references to the various charitable collections acts. You will also find reference throughout the Standard Chart of Accounts to Australian International Financial Reporting Standards, that is IFRS. And this is the collection of accounting standards, or AASBs, that are required to be compliant with when producing your end-of-year financial statements. And the level to which you comply with all or some of those accounting standards will depend on the type of organisation that you are. Presently in Australia, we do not have any not-for-profit sector-specific accounting standards, and this is one of the drivers behind the Standard Chart of Accounts in trying to achieve some consistency throughout the sector in collecting and reporting financial information. Other countries throughout the OECD, such as the United States, UK and Canada, do have a set of not-for-profit sector-specific accounting standards, which assists in those countries with obtaining that level of comparability of financial information. What I'm going to run through now is some of the benefits of actually implementing the Standard Chart of Accounts into your organisation. One of the benefits will be reduced cost, and this would be in the medium to longer term. Obviously, the process of actually going through and adopting Standard Chart of Accounts would have an initial cost. However, the benefits through reduced costs would come in the later periods of not having to translate your information every quarter or every 12 months when you're required to acquit government grants to the government departments. This Standard Chart of Accounts is considered best practice method of capturing financial information. And the reason I say that, and can say that with some confidence, is because of the wide reference group that has been involved in the project of developing this Standard Chart of Accounts. Another benefit of implementing the Standard Chart of Accounts is that it supports benchmarking. It will assist funders in being able to compare information from different organisations that they fund. But where financial information of not-for-profits is available, then it will enable not-for-profits themselves to be able to benchmark against other not-for-profits, knowing that the information has been captured on a consistent basis. It leads to consistency for users, and this is not just for external users, but the benefit can be achieved internally as well. Instances where this internal consistency would be beneficial is if you have finance staff who take leave and someone needs to relieve their position. By using the Standard Chart of Accounts and having the detailed descriptions and definitions to assist in coding, it eliminates any guesswork that may have been required in the past of wondering how the other person used to code that financial information. Similarly, if your organisation is a larger not-for-profit and you have a number of finance staff involved with entering financial information, there can be assurance that they are all coding information and entering it on the same basis by using the standard definitions. So the standard definitions there are another benefit to that implementation. It will lead to ease of understanding as it will eliminate any guesswork in trying to wonder what particular types of transactions have been captured under what particular lines in the chart of accounts. It leads to transparency of information, and it is mandatory for government departments to request information in a form that is compatible with this standard chart of accounts. So that in itself is a benefit for your organisation to move to this standard chart of accounts. Having said that, I know that being human as we are, not too many of us like change, and probably even as we're sitting here this afternoon, you are thinking already of some questions as to perhaps the perceived barriers for your organisation to implementing the standard chart of accounts. Those sorts of questions are very valid to ask, and I think need to be asked by every organisation in determining what is the most efficient and effective way for your organisation to go. I'm going to run through some of those perceived barriers now and address perhaps them for you as I go through. So the first question you may be asking is, why would I implement this standard chart of accounts when what we've got we're quite happy with and we think it works well for us? And that is a valid question for you to ask. You might be thinking changes are time-consuming and require extensive effort and therefore cost, and I don't think that's something we really want to do at this point. Similarly, you may be thinking that even though I've said a number of times now that this is mandatory for governments to use and refer to the standard chart of accounts when requesting information, you may be thinking, well, I don't think they're going to comply anyway, and I'll just keep requesting information in the same old format, and therefore there'll be a mismatch of requirements. Similarly, you might be thinking that there's a perception that large and complex organisation needs are not catered for within this document. To address a couple of those perceived barriers, the fact that it is a change will take some time and effort initially, but the benefits of implementing the standard chart of accounts will be that there is that common financial language, and this will have internal as well as external benefits. As to whether government departments will comply or not, I can only reiterate that it is a COAG decision that has made it mandatory for government departments to comply, and if your particular funders are telling you that they're not going to comply, then I would be asking some questions as high up as possible within those departments to ensure that they are complying with that decision of COAG. As far as the perception that large and complex organisation needs are not really going to be met within the standard chart of accounts, the interstate experience, which has been on the eastern seaboard, Tasmania, Victoria, New South Wales and Queensland, all adopted their versions of the standard chart of accounts from the 1st of July 2010. The experience in those states has been that there have been a number of large not-for-profits who have seen the benefits and the efficiencies of converting to the standard chart of accounts and have done so. I'm now going to move on and talk you through the standard chart of accounts and what it looks like. The words there on the screen are quite small and possibly difficult to read, but that's not the purpose of this slide. The purpose is really to talk you through the various components. So under this first column here, you can see a whole lot of numbers. These are the suggested MYOB account numbers under the standard chart of accounts. It's important to note that these numbers are not mandatory. These are a suggested numbering system that you may choose to adopt. And in this instance, if you're using MYOB, it's still a suggestion. You can use another numbering system, particularly if you have another package which uses a completely different way of numbering. That is not the key to the effective use of this document. Having said that, the numbering system that is suggested is one that follows the basic conventions within MYOB and QuickBooks of having the 1 series number being assets, the 2 series numbers being liabilities, etc., etc. The second column gives us the account names, and this is part 1 really of the 2 key parts to this document. So the one that I've highlighted there being salaries and wages. Then in the next column you can see a detailed description of that salaries and wage information. This particular column in this instance refers to salaries and wages being a header account, and I'll talk through what that means in a minute. Underneath that salaries and wage accounts is a whole lot of other different accounts: salaries and wage annual leave expense, salaries and wage fringe benefits tax, long service leave expense, etc., etc. And there are more definitions on the next page of that chart of accounts. And for each one of those, there is a detailed description of what type of information is to be captured under that account name in your chart of accounts. And this is where that data dictionary that I've been talking about is captured, where the detailed guidance on what type of information to be coded to the various account names, that's where that information is. And that's where this document provides that consistency amongst all organisations in the sector when they're using this standard chart of accounts. Next column across, which on this particular page here is blank, but this is where if there are reference to IFRS or the accounting standards, that's where those references will be. If there's a particular piece of information that needs to be captured in order to be compliant with a particular accounting standard, then that will be, the reference to that standard will be in that column. One example which sits within expenses is to capture details on the loss of sale of assets. And there is an account set up for that. And then it will give you the reference to the relevant accounting standard being AASB 116. So throughout the document, that is where you will find that information. This final column on the right is where there is space for other comments. And this is where you will find reference to any other relevant legislation, such as the Charitable Collections Act or Income Tax Assessment Act, or those ones that I talked about earlier. In this particular example, there is a comment under salaries and wages, salary sacrifice, and the comment directs you to the part of the ATO website that discusses salary sacrificing. So in this instance, it's giving you a place to go for further information should you require it. Okay, so I mentioned header accounts, and you will find reference throughout the standard chart of accounts to these header accounts. What are header accounts? Well, they're non-posting accounts. Information doesn't get posted directly to these accounts. What they do is that they aggregate the total of all the sub-accounts that sit underneath those header accounts. And a good example of that was the salaries and wages page that we were looking at a minute ago, where the top account, the header account, will be the total of all the various components that make up salaries and wages, being the cash part paid out, any salary sacrifice, annual leave, sick leave paid out, and there's more information within that data dictionary there. What that gives us then is it eliminates any guesswork. If you're having to acquit your total salaries and wages to a government department, then there's no guesswork as to what is actually required. It would require the total of all those sub-accounts, the ones that are relevant to you, that make up that total salaries and wages, which would be the amount reported. Other examples throughout the standard chart of accounts of header accounts is inventory on hand, plant and equipment, employee benefits and provisions, sales of goods, client support services, depreciation and insurance. And the data dictionary within the standard chart of accounts gives detailed explanations of these types of costs and what should be included, and in some instances what should be excluded as well. These accounts and more can be used as header accounts if required, particularly the larger and more complex the organisation. They may wish to make a much wider use of header accounts within the standard chart of accounts and have sub-accounts underneath to capture the level of detail that is appropriate for that organisation. We would find that the smaller and the organisations with simpler structures would tend not to use or have the need to use as many header accounts. I now want to move on to talk a little bit about cost centres. Cost centres can be used within your accounting package instead of building additional accounts into the chart of accounts. Now, this generally does refer to MYOB and QuickBooks, as the research does suggest that the greater majority of not-for-profit organisations tend to use MYOB and QuickBooks. However, I do recognise that there are other accounting packages that not-for-profits use, particularly larger organisations tend to use some of the larger accounting packages that do use particularly cost centres a little bit differently. Some of them even have their cost centres built within their chart of accounts, such that there can actually be quite a substantial chart of accounts because each cost centre or job centre sits in the chart of accounts with a chart of accounts attached. If that is applicable to you, you still are able to make your chart of accounts compatible with the standard chart of accounts by ensuring that for each cost centre, the general ledger codes that are used are compatible with the standard chart of accounts. As a matter of interest, it would be helpful to me if you could just type into the text box the type of accounting package that you use for your organisation, just to give me a bit of an idea about what you're using. Okay, so we've got MYOB, QuickBooks, we've got Greentree, Technology One. Okay, some Cybiz as well. A few more MYOBs. Okay, so there's a bit of a variety, which is to be expected, as I said, but generally within the sector, the majority use MYOB or QuickBooks. And you will find that where I refer to various tools that are available to assist in the translation, that at this stage the electronic versions are MYOB and QuickBooks compatible only. That doesn't mean that you can't convert if you're on another package. We'll talk through the methods that are available in a few moments. So using cost centres, in MYOB they're referred to as job codes, and in QuickBooks they're referred to as classes of transactions. And for those using other accounting packages, they may have other names, but the function or the purpose of them is generally the same. A basic demonstration on the use of cost centres and the benefits of using cost centres. In this particular organisation, I have 3 different expense types, being salaries and wages, motor vehicle expenses, and travel and accommodation. But I also have 3 particular regions within this organisation, being the North, the South and the East. And you can see on screen there that currently I have a separate general ledger account for each account type per region. What this doesn't enable me readily to do is to find out what are the total costs for, say, the Northern region. If this was in MYOB, what I would need to do would be to export that information to Excel and then sort it and then subtotal it to find out what the Northern region was costing me. The use of cost centres, the cost centres generally sit to the side of the chart, apart from, as I mentioned earlier, with some of the larger accounting packages, they are built within your chart of accounts, and that obviously structure can't be changed. But for example, in MYOB and even QuickBooks, they tend to sit kind of to the side. What this automatically does is you can see that it's reduced the number of general ledger accounts that I have from 9 down to 3, and I can collate the information that I need on a region by region basis. So I can run an income and expenditure report which will show me the total costs of each region. The amounts that will appear in the general ledger for each of those will be these amounts in the total column. Whilst QuickBooks tends to be a little bit better in the way that it uses cost centres, it has a little bit more functionality, and MYOB still is a little bit limited in its use of cost centres. You can still see the benefit of using those in the fact that it declutters the general ledger and takes that information and has it, in a sense, on the side. We're going to look at actually managing the conversion process now and what the steps involved actually are. There are 2 methods of conversion available, being electronic conversion and manual conversion. The very first step before doing any kind of conversion at all is to back up your data. You would need to electronically copy your file, create a backup copy, and store it in a safe location. I would recommend doing a couple of copies in 2 different locations just to be sure. I would also recommend restoring your backup copy before you go on and do any further work to ensure that the backup effectively worked. So you would back up prior to doing any conversion work, and I would also recommend physically printing out a copy of your trial balance and your chart of accounts before you start. The best time to do any conversion would usually be the beginning of a financial year. If you're a 30 June year-end organisation, then that best date to convert would therefore be on the 1st of July. If your year-end was 31 December, then it would be 1st of January. The reason for this being is that to try and convert anywhere during the financial year would be a lot more difficult process, in that you would have to convert your profit and loss information as well as your balance sheet. But similarly, it would make comparison on a month-by-month basis quite meaningless. With electronic conversion, there are tools available to assist you with this. What actually happens is that the standard chart of accounts is uploaded to your accounting package and completely replaces the current chart of accounts. The tools in order to do this are only available for MYOB and QuickBooks files, and there is a reference on the screen there to the Queensland University website which contains those tools. You may wonder why the reference there is to Victoria and not South Australia, and that's simply a timing issue in that the South Australian Standard Chart of Accounts has only recently been adopted, and that website hasn't been updated as of yet. but all the information you require will be under that Victorian part of the website. And there's lots of other helpful information available on that website to guide you in this process. The electronic conversion method, as it completely replaces what you've already got, is really only applicable if you're planning to start a brand new data file. You would have no historical information. Obviously, you haven't lost that because you've created a backup copy and you've stored that somewhere securely, so you could refer to that should you need to. But you would lose the ability to run any kind of comparative reports or to look back within your current data file on any historical transactions. So if this is not for you, you're not wanting to start a completely new data file, then the other choice is to look at a manual conversion. Manual conversion involves two steps. Firstly, mapping your existing chart of accounts to the standard chart of accounts, and then manually updating the software with the new chart of accounts. The benefit that you would obtain from using this manual method is at the end of it, you end up with basically a conversion manual, which in plain black and white will show you where an old account, where information was to be coded to an old account, the new account to which that relates. This could be particularly useful for finance staff in the early stages of becoming familiar with the standard chart of accounts. Often what I've come across in practice is finance staff who, particularly those who've been in organisations for a significant amount of time, can almost recite account numbers in their sleep. And so for them to make a change to a new set of account numbers or names can be quite a big thing. And this reference document would provide them with a quick reference in those initial stages until they became familiar with the new chart of accounts. Okay, so the steps involved in actually mapping your chart of accounts to the standard chart of accounts are as follows. Firstly, you would print out your existing chart of accounts and trial balance or download it into a spreadsheet. Then you would print out the standard chart of accounts or download that into a spreadsheet also. The next step will be to review the accounts in your existing chart of accounts. So this would involve going through on a line-by-line basis, reviewing the accounts in your existing chart to determine the best treatment under the new standard chart of accounts. Probably the easiest place to start would be the unused or nil balance accounts. These are accounts that haven't been used for a significant period of time and you know are not going to be used, therefore, into the future. These accounts can be marked in a way for deletion or inactivation, and I'll talk that through in the next part of this process. The second type of accounts will be those accounts that are easily compatible in both versions of the chart of accounts. For some of them, it will be readily obvious where the old account, what that was, and what the equivalent is in the new standard chart of accounts. For example, petty cash. If you've currently got a petty cash account in your chart of accounts, there's a petty cash account under standard chart of accounts. The only change that you may need to make, should you choose to do so, would be potentially to change the account number. As I mentioned earlier, though, that in itself is not compulsory. You would then be left with a number of other accounts, which on first glance, it's not readily obvious what is the best treatment under the new standard chart of accounts for them. You would then need to do some further work on each of those accounts on an individual basis. Some of that work may be to have discussions with other management within your organisation to decide on the best treatment for the recording of that information. I would also recommend having a detailed understanding of the type of transactions that are recorded to the account currently. simply looking at the account name may not give you the full picture. You would need to understand the detail of the types of transactions that are being coded to that account name to understand or to make a decision as to the best treatment of that information in the standard chart of accounts. I do have an example that I can talk you through which will highlight some of those examples. Hopefully you all got an email of this information prior to the session. It's a document called TB Conversion. Basically what I did is, if you do have it handy, if you would like to refer to it now, the document on the left-hand side is where I downloaded. This particular example was a MYOB one, so it's got the account number and the account name on the left-hand side of the page. And on the right-hand side of the page, I have gone through and done exactly what I've just talked you through on a line-by-line basis, decided on the best treatment under the standard chart of accounts. In this particular example, I chose to follow the numbering system within the standard chart of accounts. So, but as I've said before, that particular part is not compulsory. Throughout that example document, you will see that on the right-hand side there, the SCOA compatible trial balance, I've highlighted some cells. These are ones that I will talk through a little bit now. On the first page there, I've highlighted the various plant and equipment accounts. The standard chart of accounts simply gives two chart of accounts for plant and equipment, one being for the asset itself, plant and equipment, and the next account being accumulated depreciation on that plant and equipment. However, in my example here, I decided that I would like further information in order to aid reconciling and management of those assets, and so I've created sub-accounts that would sit underneath those header accounts being plant and equipment and accumulated depreciation, and I've separated them by type of asset, by location. So you could do similar depending on the needs of your organisation and the way that you felt was best to manage. On the front of the next page, if you look down at starting at about account number 21805, in my original example there was a whole lot of one-off grants that for each of those a separate general ledger account had been created, a liability account. Under the standard chart of accounts, these would be categorised into one of two accounts, being grants received in advance operating and grants received in advance capital, depending on the nature of the funding. If I then wanted to maintain further information, I could do that either through a level of detail within MYOB or through using job codes. So that is one instance where a number of accounts in the old chart of accounts will be combined into one or two new ledger lines within the standard chart of accounts. Another example that I would like to refer you to is on the second to last page, the back of the second to last page. In my initial example, I had one account, 63100, being audit and accounting fees. Under the standard chart of accounts, accounting fees and audit fees are recorded separately. The reason being is that under accounting standards there is a requirement to separately disclose auditing fees in your financial statements, and so a general ledger account has been set up in order to capture that information. So that would involve me in this organisation actually splitting the amounts in that account between two new general ledger accounts. Another example that I would like to highlight to you is if you move onto the front of that last page, the account number originally being 64710, business printing. You can see on the right-hand side of the page there that I've given two choices under the new standard chart of accounts of where that information would be coded. That being advertising and promotion or publication and information resources. The reason I've come to that decision is because of my understanding of the type of transactions that were originally being coded to that business printing account. On reading through the standard chart of accounts and the definitions involved within that, I knew that some of the transactions currently coded to business printing were actually fell under the definition of advertising and promotion, and other types of transactions also currently coded to business printing actually fall under the definition of publication and information resources. So you can see from this example that there would be some accounts that would need to be combined into a single account under the standard chart of accounts, but there will also be some accounts that may need to be split and coded in a couple of different places depending on the definitions. But hopefully you can also see from this example the way that that will assist in that comparability both within the organisation and across organisations, because no longer to continue on with the same example, we don't have to guess what is business printing, what's actually included within that, because it will be split under advertising and promotion or publication and information resources, both of which have very clear definitions within the standard chart of accounts. So it removes any guesswork that may have been there in the past. Okay, so the end result of going through that process, such as I have just briefly walked you through in that document, is that all accounts from the old chart of accounts will be allocated a new account name and possibly a new number from the standard chart of accounts. Some accounts will need to be combined under the new standard chart of accounts, and some accounts may need to be split. You also will have, as I mentioned earlier, that mapping document that gives guidance on where various transactions need to be coded if people aren't quite sure in those first initial periods of recording information. I'm now going to talk you through the updating of your accounting software. You've got a document that you're happy with. You've been through all of your accounts in your old chart of accounts and you've allocated a new account name and or number under the standard chart of accounts. So we're firstly going to start with that document which shows that mapping. What you would then do is, if you were to start with the dormant accounts, the ones that you've identified as not being needed anymore, I would renumber those, and I would renumber them somewhere right down the bottom of your chart of accounts, right towards, if you're using MyOb, somewhere way down in the 9 series of numbers. I would mark them as inactive within the accounting package so that they can't be posted to, and I would also, in the descriptor of those accounts, put do not use or DNU, just to indicate in some way that those accounts are no longer active accounts. For those accounts that are easily transferable from the old chart of accounts to the new chart of accounts, that would involve renaming them, and if you choose to renumber, then renumbering as well. This may not be quite as straightforward as it sounds, in that if you choose to renumber, when it comes to physically trying to do that process, I'll give you an example. If you had petty cash previously being account 1010 and you wanted to change it to 1020, if you already had a 1020 in your general ledger, your accounting package isn't going to allow you to create another one using the same number. What my advice would be there would be to allocate an interim number, either somewhere right down the bottom of that 1 series or right down the very bottom in the 9 series, for example, as an interim measure, and once you've renumbered all the other accounts, to then go back and allocate the final account number to that. It's a little bit of a pest having to do that two-step process, but as long as you document what you're doing, you could document your interim number on your mapping document as well. That should be a relatively straightforward process. Then what you would need to do would be to join accounts that need to be combined. In the later versions of MYOB and QuickBooks, this can be done automatically by your accounting package. And if you're not sure how to do that, I would recommend going to the help menu of those two packages and search combining accounts, and it will step you through the process, which is quite simple. If your accounting package, you either have an earlier version or your accounting package does not allow you to do that, then you would need to do a general journal transferring the balance from those old accounts into the new accounts, and then you would need to go back and rename, renumber and mark as inactive those original accounts that are no longer going to be used. Once you've gone through that process, you then need to look at your linked accounts to ensure that where you have linked accounts set up, that they have been updated due to any changes in your accounts. So what are linked accounts? Well, linked accounts are accounts that are used by certain transactions and they're not directly posted to by you as the user. For example, if you use the payroll module of your accounting package, when you go in and enter that payroll information and then process it, that payroll information is automatically posted to the various linked general ledger accounts. Similarly with GST, if you're entering a purchase transaction and you code it as a GST transaction, the GST component of that is automatically posted to the GST account in the balance sheet. So these linked accounts only need to be set up once, and I would recommend checking that the setup is still correct after conversion before you begin processing any information. If you're unsure about how to actually do this, or you have any problems when going through this process to do with linked accounts, I would recommend contacting your software provider or some of the assistance options available at the end of this presentation. Just to show you though what it looks like within MYOB and QuickBooks, if you do want to check your linked accounts, in MYOB you go to your setup menu, then to linked accounts, and in this instance to check the payroll linked accounts. And you can see from that screen dump, it shows you where the various transactions are being posted, and you can check that that information is correct. If it's not, you have the ability to correct it before you go on and process transactions. Similarly within QuickBooks, within the lists menu, you can check the payroll item list, and in this instance PAYG tax, and it will tell you to which account the PAYG tax is being posted. Another item that I recommend you check before doing any processing in your post-conversion accounts is looking at recurring transactions. Many organisations will utilise recurring transactions where you do the same transactions many times. I would check the recurring transaction list to just ensure that what the accounts that you previously used and have potentially changed have also been changed and updated within that listing. This should happen automatically when the account numbers are changed, but I would check it prior to processing or to using any recurring transactions. Finally then, you need to verify your conversion to make sure that it has actually happened accurately and effectively. So the first step being there to print out a copy of your new trial balance from your post-conversion chart of accounts. You would then need to compare that new trial balance to the pre-conversion trial balance. I would firstly start by checking the total down the bottom of the trial balance, making sure that the totals are the same. If you're happy that those are the same, then I would check by a category by category basis. For example, do total assets equal total assets? And then on an account by account basis. Where you have combined some accounts to form a single account within the new standard chart of accounts, you would need to add up the old balances and ensure that the new balance is the sum of those old balances. And similarly, where you have split accounts, where one account in the old chart of accounts has become two or potentially more in the new standard chart of accounts, you would need to ensure that those totals also agreed. At this point, you would need to correct any errors that you came across. In the unfortunate situation that you can't identify the source of any errors, you may need to go back and start the process again from the beginning. But I do hope that that doesn't happen for any of you. Finally, once you're happy that you've verified the conversion has happened effectively and is accurate, you need to back up a copy of that data file. You need to have a copy of that which you then store in a separate location prior to processing information. I would also recommend printing out a copy of your chart of accounts and trial balance before any processing takes place. This serves a dual purpose. It gives you a clean copy that you know that you are happy that the conversion occurred accurately. It will also provide your auditor with the information that they require in satisfying themselves that the conversion took place appropriately, and they can see the evidence of that. Once you've done that, you are then ready to begin processing information in your new file. If you happen to use MYOB, and some of the other accounting packages would be similar, there may, given that you're doing this on the first of an accounting of a new financial year, there may be a period under which you need to record transactions in both the old copy and the new copy, being that if you're a 30 June year end, you normally aren't ready and haven't finished year-end on 30th of June. You may have some year-end adjustments being accrual type entries that need to be processed, or some audit adjustments that also need to be processed. So they may need to be processed in both locations in that interim period until your audit is finalised. But after that, you are ready to use your file. Want to go through a few frequently asked questions now. Firstly, is there an Excel spreadsheet to download to compare our chart of accounts with the standard chart of accounts? And there is, and that's available on the Queensland University website. The reference there is given on screen. When is the best time to implement the standard chart of accounts into our business? And I have mentioned that being the beginning of a financial year. What I haven't mentioned is my recommendation that when you do plan to move to the standard chart of accounts at the beginning of a new financial year, that you budget on the same basis. So you prepare your budget based on the standard chart of accounts rather than your old chart of accounts. Otherwise, you could spend most of the year converting or explaining budget differences on this conversion process. And given the current date today, being into June 2011, it's unlikely that many organisations will choose to convert and be ready to go on the 1st of July 2011. That having been the case, the 2011-12 financial year may be an interim period where you do have some translation in order to convert information into a form that's compliant with the standard chart of accounts. And you use this as a planning year, getting ready to start doing this conversion process if it's going to be manual in, say, February, March of 2012. You would then be ready to budget on the basis of the new standard chart of accounts in March, April 2012, and then you could actually go live in using the standard chart of accounts on your system from the 1st of July 2012. How do I load the file into MYOB? And that could say QuickBooks as well. The technical details of that I won't go into now, except to say if you go to that Queensland University website, the one that's on screen, That will give you the information that you need, it gives you the file that you need, and it will step you through the process. Do I need to use all of the standard chart of accounts? The answer to that is no. You only need to use the parts that are applicable to your organisation. You would need to consider internal reporting requirements, external reporting requirements, that being either from your funders or from other various legislative or accounting standards requirements. But if anything outside of those requirements, if it's not relevant to your organisation, you don't need to adopt that part of the standard chart of accounts. And one example may be for many not-for-profits, inventory is not an applicable part, and those parts can therefore be not used. How do we map in-kind accounts to the standard chart of accounts? Generally, they would be created as a sub-account of a more general header account or as a second account under the existing account. For example, if you had legal costs that were account 1, 2, 3, 4, and you also had legal costs in kind, you could create either account directly underneath, being 1, 2, 3, 5, as either an account that sits underneath or a sub-account of those legal costs. Finally, what happens to our prior year comparative figures? Unfortunately, I don't have a simple answer to that question. If your conversion has been fairly significant, then you may find that your prior year comparative information is not really relevant to be referred back to. You would then need to make a decision on an organisation basis as to how important it is for the users of your financial information to compare back to prior year. If it is something that is important, then you would need to go through the exercise of converting those prior year comparative figures to be consistent with the new chart of accounts. However, you may decide that it's not something that for that first year is incredibly important, and that it's more important to be able to compare budget versus actual for that first year. From the second year onwards, you would then have comparative information available to be used. Are there any questions that has come out of what I've said this afternoon? If you do have a question, please type it into the box and I can address it. I'll just give you a few moments to do that in case you do have questions to type in. Okay, so far either you're all quite confident about it all, or you're all still processing the information, which is quite understandable. What I will do, if you still feel free, if you do have questions, to type those into the box, but I will go on and give you this further information slide. This refers you to some places where if you have questions after the session today that you would like addressed, there is some references there. The first being our organisation, Not-for-Profit Accounting Specialists, our telephone number, my email address is there, and our web address is there too. The second bullet point has reference to the implementation manual, and there is a funny little web address there. What that is if you would like additional copies of the implementation manual, then it's on our website, but it's in a bit of a hidden location, so that's the way to get to that. So you're more than welcome to go to that reference and download additional copies of the implementation manual if you've got other people in your organisation for whom that would be useful. I've also given you the reference to the Queensland University website. As I've mentioned a couple of times, there are a number of resources available there which will assist you. Because the eastern states are sort of a full financial year ahead of us, there's been experiences that have come out of there. There's a chat location where people have entered questions and you can see answers to those questions, and there's all sorts of things there. Should you need to contact your software providers, if you've got specific software questions, then I'd guide you towards those. And finally, there's a help desk available if you've got any quick questions, a 1-800 number there, and that will be maintained for the next financial year up until 30th of June 2012. Okay, so that is the end of the formal part of the presentation. Unless anyone does have any further questions, I can stay for a few moments if you're still typing in a question that you'd like me to answer. Otherwise, you should have a feedback form that will come up at the end of this session, and I'll just ask you to take a couple of minutes to fill that out to assist us, then that would be great. Otherwise, I wish you luck with the translation process if that's what you decide to do in converting, and thank you for attending this afternoon.
Thanks, Sue, and thanks to everyone for joining today. We do hope that you enjoyed the session, and we look forward to seeing you at future webinars. As Sue mentioned, there is an exit survey which will appear once we close the conference. So thanks once again for joining, and have a great afternoon.